I'm delighted to be here again. We did a few IS and one IFRS when I was in Canada. We discussed IS 27, IS 28 at that time, and IFRS 3. That's what we discussed. So I will just quickly, I will go through what we discussed, not in detail, but very bird's eye view, I think I will be giving you on that. It's all related to investment actually. Investment can be various types. It can be a simple investment where you have to apply IFRS 9, which is for investment in share, uh, prescribed that it should be at fair value through profit and loss. Otherwise, you can make an election where you can show it at a fair value through comprehensive income. So the other is the subsidy where you have a control. So then you have to apply IFRS 10 for consolidation. We will be discussing that today. And it could be a joint operation. In that case, IFRS 11, we will be looking at that today. And in case of associate or joint venture, where can be a joint control or where the shareholding give you the significant influence, then we apply IS 27. So this is accounts various involving the various kind of investment. And if an entity prepares separate account, then IS 27 is applicable. And in a separate accounts, the entity required to either apply cost method, equity method, or IFRS 9. For one method for one category, whole category. So anywhere you have a question, please let me know. Otherwise, I'm just skipping through very quickly. IS 27, we deal with the financial statement, separate financial statement. So IFRS 10 deal with the consolidated financial statement where a parent has to present all his subsidies just like a single economic entity, which we call the group account or consolidated accounts. And separate account, I said that's already I discussed that three methods are available. And if you receive the dividend from that investment, and if you are not applying equity method, but you are applying cost or IFRS 9, then when your right to receive dividend is established, you can take it as a income, dividend income. But in equity method, we take the share of the profit and we earn. So add it to our balance sheet figure. But if the dividend is paid, then it's not shown as an income, rather it's deducted from the equity balance. Then consolidated IFRS, which is IFRS 10. We'll be looking at what I discussed in my last, they deal with the consolidated financial statements. The old IS 27 were used to deal with the consolidated as well as separate accounts. Now for separate account, we have a new IS 27. For consolidated, we have IFRS 10. Basically, why this new IFRS 10 is given, the reason is that there was some flaw in IS 27, particularly that flaw was related to the definition of control. Because the definition of control was defined in a way where the entity has a right to govern, a power to govern financial and operating policy of an entity, and from where it can obtain the control from the activity of that investee company, then is used to known as control. But now, under the IFRS 10, the definition of control has been addressed, and IFRS 10 deal with the accounting requirement to prepare the consolidated financial statement, but it does not talk about again for the matter already we discussed under the IFRS 3, like which value we should use for the assets and liability of the company we acquire, and how to work out the goodwill, how to reflect the and calculate and measure the non-controlling interest. All is covered in IFRS 3. So IS 10 does not deal with those again. Okay, so when there is a control, then regardless of the nature of the subsidy, you need to consolidate. The definition control is basically, it has three components. One, as an investor, you are exposed to or has right to variable return, and the second, you have the ability you have the ability to direct the company entities relevant activity. As a result of that power, you can affect the size of the return. So if these three things are there, which on the next slide I will look at these three components again. Number one is the power, your current ability to direct the activity of the investing company. This is the number one. Number two, your exposure to variable return. And third, your this power gives you the ability to affect the size of the return. If all the three are there, you can say after number two, there's a and. So if all the three conditions are there, then we say it is the control. Any one of them is missing, it's not they indicate the control exists. Okay, so what is the mechanism of consolidation? Same mechanism which was given under the IS 27, old IS 27. Same is there. But however, one thing is there. When they were reviewing these group related IFRS, then they realized the disclosure is not very uh, right. There are overlapping, there are gaps. So they moved all the disclosure requirement to IFRS 12, whether it's associate company, whether it's a subsidiary, whether it's associate, whether it's a joint venture. All disclosure has been, one, they have been expanded, and second, they have been moved to IFRS 12, which means no other, I just talk about the disclosures. And IFRS 3 we looked at, and remember, we said you take all the assets and liability of the company you have acquired at the fair value at the date of acquisition. And the controlling interest can be shown as a percentage of the fair value of net asset at the date of acquisition or fair value of the non-controlling interest. We talk about that, and we need to work with the goodwill. It could be a goodwill, it could be gain on bargain purchase. If the goodwill, we will take it to balance sheet. We will not amortize, rather we will test it for impairment every year. And the if it's a negative goodwill, which is a gain on bargain purchase, we will check our calculation just to see there's no apparent error there. If we are sure that this is a gain, then we can take it to profit and loss account. Okay, this is what we broadly discuss when we're looking at the IFRS 3. Okay, so two things which I wanted to remind you here. One is the calculation of goodwill, and goodwill not need to be amortized, and rather it to test it for impairment. And there's a two way to take the work out the goodwill. One is called net goodwill or gross goodwill. When it's a net goodwill, is related to the group only. When the gross goodwill is the total goodwill, which also has the share of the minority interest as a controlling interest as well. So if we take the percentage of net asset, like in this case, the percentage of net asset would be on the figure of 200, 80% of that. If we take this way, then the goodwill on 20% of this 200, then 40 would be the goodwill as per adjusted fair value, net fair value of the fair value of the net asset at the date of acquisition. Or we can check that what is the fair value of non-controlling interest, and this way there's a difference of 5. It will affect the calculation. Okay, so as for the controlling interest, non-controlling interest is concerned, I told you the non-controlling interest. I just said that it could be proportionate share of the acquired net tangible asset, fair value of those, or it could be the straight away the fair value non-controlling interest. It brings the impact on the goodwill. Like here, if you have a consideration of 300, continue with my example. 300, we acquired 80%. If that's a cost of investment, then the fair value net asset 200, and 20% is the non-controlling interest of that, because we are not working on the value of non-controlling interest on fair value base. Rather, we are taking the proportionate share of the fair value of net asset at the date of acquisition. You see, goodwill is 140. On the other hand, if you don't take the controlling interest, the 40, which is a proportion share of the net asset at the date of acquisition, fair value of net asset date of acquisition. Rather, we take it at fair value. Then it's not 40, it's 45. As a result, the goodwill is a difference, the 5 exactly. That's what is based on the how we take the non-controlling interest. There's the option in working on the non-controlling interest, which impact the goodwill figure. Okay. And the goodwill, as I said, not amortized, rather is tested for impairment every time. If they gain, rather otherwise negative goodwill, we take it to reassess and then we take it to profit and loss account as an income. And this is again the calculation we made at the date of when we discussed the earlier thing. Like we have a cost of investment of parent 150 sitting in our accounts. When we prepare the consolidated account, then this cost of investment has to be eliminated. In lieu of that, we need to bring the assets, the liability, the fair value non-controlling interest, which is 42. The difference figure is 8, which is the in this case the gain on the bargain purchase. It could happen on this side if the other side would have been larger, so it would have been on this side. So then it would have been a goodwill rather than negative goodwill. So this is basically substituting the cost of investment with the asset, net asset of the entity. Okay, we have acquired the 80%, and we know what is the fair value of the non-controlling interest. On the basis of that, instead of 151 figure, various figure has been substituted to prepare our consolidated accounts. Okay. Right. Then IS 28, we deal with the associates and joint venture. Earlier, we had two different IS, 20 for the joint venture associate and the 31 for the joint venture. Now they have brought everything to one place, which is the IS 28, both investment in joint venture and investment associate, both have to apply, for both we have to apply the equity method, all right? And associate, we always look at whether significant influence exists. If significant influence exists, then we take it associate and we apply the equity method. So significant influence is basically power to participate in financial operating policy decision. It's not controlled. And then there is a joint arrangement. Joint arrangement means an arrangement where two or more parties have a joint control of the entity. So joint control means where they have to act with the unanimous consent. No single party can make the decision. Under the contractual term, they have decided that both will the consent would be there, and then this is called joint control. Okay, so joint arrangement is where more than two or more parties have a joint control, and the joint control means no unilateral action. So this is a joint venture, which means where the investor have the right to the net investment of the arrangement. It's a very important right to net investment. Okay, because I will distinguish it from the joint operation, where the investor will not have the right in the net asset, rather they will have a right in the asset of the company and obligation in the liability of the company. Their share in assets and share in liability, not in the net asset. We'll see the difference when we look at the IFRS 11. Okay, so joint venture is the party to a joint venture, and the equity method we have already looked at. Equity method, I said to you today as well that in the equity method, we adjust the cost of acquisition of the share in the beginning with the post-acquisition change in the investor's share of net asset. And if we receive any dividend, we reduce the dividend amount we receive from that figure instead of taking it as an income. Okay, so these are the indications few examples by which the significant influence can be witnessed. Representation of the board of directors or equivalent governing body by the investor, and the participation in the policy making process, including the participation in decision about dividend, other distribution, material transaction between the investor and investee, and interchange of managerial personnel between the investor and investee, and the provision of essential technical information, sharing of those information with each other, investor and investee. Any of these can evidence that there is a significant influence. That's what we discussed already in our last discussion. So I thought maybe some new people might be joining. Then instead of just starting fresh from the new thing, so it is better if we spend 10, 15 minutes on that. So I'm glad that we have spent the 15 minutes on that to cover what we already covered in our last session. Any questions so far? Okay, good. Right. Now IFRS 10 is basically our subject of discussion. The objective of this IFRS is to lay down the principle for the preparation and presentation of consolidated financial statement, which is prepared by the entity which has a control. And they include themselves there, the investor include itself there, and also all the subsidiaries. The standard requires a parent entity to present consolidated financial statement, and standard define the principle of control, which is a 3-point already we discussed those. So define the principle of control and establish the control, because if control is there, it will form the basis of the consolidation. Standard sets out how to apply the principle of control to identify whether investor control the investee and therefore must consolidate the investee company in its consolidated account, and standard set of the accounting requirement for the preparation of consolidated financial statement. That's the real objective of this standard is. Okay, sometime some investor some party have a protective right, right? So protective right not necessarily gives the power of control. Like maybe you say there are 3 investors, you say whenever dividend will be declared more than a certain percentage, you can decide freely up to that percentage, but if you want to exceed that, then you have to have a yes of party C, because that is there to protect his rights, so that there's not a over depletion of the resources of the entity. So that's the protective right. If some entity has on some point the veto power as the main vote, then it doesn't mean they have the control. For control, you have to prove that they have the exposure and right to variable return as well. Not only just the power, right? The protective right is for different reasons. So I already said in last paragraph, in the last slide, the protective right not give you the control, and you are not required to consolidate. Okay, so the protected right could be straight away through the voting right, or it could be a part of some contractual arrangement, right? So where some party enjoys the protective rights. Similarly, sometimes some party is the agent of the other party. Okay, and now that agent is exercising, directing the activity, right? Which have a effect on the return, and return is a variable. So, but because that agent is working for the principal, maybe freely, but doesn't have the control. An agent will never consolidate. So only the consolidation will be the party, which is the principal on which behalf the agent is exercising the power. Okay. So identifying the relevant activity, what mean by the relevant activity mean? The activity which significantly affect the return size. The activities which affect the return size, they are called the relevant activities, such as determining or changing the operating and financing policy, making capital decision, appointing, remunerating, and terminating employment, and services provider, service providers, and key management personnel. So that are the relevant activity. Two or more party may each direct the activity, right? So in this case, what will decide? Two party have. I give you the example. Under a arrangement, it said that the seller will continue to have a 3 years control, and then after 3 year, buyer will have the control. So two party have the control. But we'll look at who currently has the ability to direct activity. Basically, that party would be, that entity would be having the control, okay? After 3 years, then the other party control may shift to other party. But as currently, the party has the has control to direct the activity. Okay. Mr. Sadiq is waiting for to be admitted. Okay. And then we also look at that. Let me. Okay. I mean, the activity, what gives an investor the current ability to direct the relevant activity? The following things give an entity the ability to direct the relevant activity of the investing company, which is one is the voting rights, and the other is a potential voting right. Third is the decision-making right under a contract, and the removal right, kick-out right, and the right to appoint key personnel. These kind of activity, if you have a control over that, you have the ability to direct those, then we will say through this way. This is the mean of directing those activity. Okay, we can take one by one. Okay, I need to admit people. Okay. Okay. So here voting right, if you look at, the investor may have the power with less than half of the voting right. It's not necessary the entity which has the control should have a more than 50% voting right. It's not necessary. It could be with the less. It can be still having the control. We need to consider the fact and circumstances to determine the control. Could be through a contract, there are right to have the control. And could be the size of investor holding a voting right relative to the size and dispersion of other vote holders. The voting right, absolute amount, voting right relative to other voters, like absolute amount means they already have 60%, okay? They have less, but the other voter have a relatively very, very small shareholding. Number of other vote holders that would need to act together. We have to look at whether the other people have the chance of acting together or practicality of acting together. So we look at that. Then second, the potential voting right. I will look at that as well. You don't have currently, but I'll give you the example of potential voting right. And the voting pattern at a previous shareholder meeting also be looked at to decide who controls. Okay. Let's say there are two examples. Example one, H has the 48% investment in a company, and the other 52% of widely dispersed. Some party have 1%, some party have 3%, some party have 5%, some party have 9%, and they are maybe 40 investors altogether who hold 52%. So even with the 48% in this case, the A has the power, because for these 40 coming together and pulling up 52% and deciding 10% next to impossible. But the other, in example two, in company C has a 45%, and in company D. And the other shareholder are just, you can say, 3 shareholders. two of them each holds 26% each, and the three hold 1% each. And in this case, the C does not control D because it's quite practical that the two shareholders which hold 20% each may act together more likely. Okay. So therefore, they will deny the control of C. So in this case, so that's why we have to look at this, what I said on the earlier slide. Okay. And the potential voting right examples are options, warrants, convertible instrument, but they have to be substantive right, under some agreement, under some law, under some regulation. That's substantive right, right? It's not a right in the air. Okay. So then we look at, does the holder have the practical ability to exercise those rights? Are the rights currently exercised? But two questions we look at. One, because there is the option, they are convertible instrument. The practical ability means, does that investor has money, funds, approval of his other shareholder from in the company to go ahead and exercise the right? So look at the practical ability. Although right to exercise is there, but the practicality has to be looked at. And second thing is, are the right currently exercisable? I give you the example. If they say that to have the right to exercise by the year end, you have the right up to 31st December 2028, right? You can exercise. It is the last date. But you can start exercising from this date, which could be 31st December 2025, right? So there's not yet 2025, 31st December 2025, which means you cannot exercise the right. But if you enter this area, this one, although you are waiting for the further change in the value of the share, you are waiting and seeing, but you have the right to exercise in this period. So that's why I say, do you have the right currently exercisable? In this period, you don't have the currently exercisable right to exercise. But here you have, although you are not exercising the right, because the date till that you have the time is 31st December 2028. So we are talking about this period, because there you have the right currently exercisable. Like an entity has 28% voting right currently, okay? And they have an option which can give the control of 24% further in the company B. Now we look at these two things, three: substantive right under some agreement, under some instrument. Second, practical ability of company A to exercise. Third, the rights are currently exercisable. Yes, we'll add the both and decide whether the control is there or not. Okay. Agent, we already talked about. Agent is a party engaged to act on behalf of another party, which means the principal. The principal may delegate some or all the decision-making authority to an agent. A company, the agent company does not control an investee, and we need to consider all the facts and circumstances about the appointment of the agent, and we have to see that. Okay, like this is the yellow is the investee company. Who will consolidate? Agent or principal? The answer is the principal, not the agent, because the agent is acting on behalf of the principal. Basic control lies with the principal. Okay, to control an investee, an investor must have the variable return from its involvement with the. This is very important area, the variable return. Okay, it's not the everything. If the variable return is there, but the other factor are missing, it doesn't mean the control is there. But variable return is a very strong indicator, one indicator of the control. So this return could be positive, could be negative, could be both, sometimes positive, sometimes negative. and the return is I mean combination of our the sum of total of dividend, distribution of economic benefit, changes in the value of investment. This we call it capital appreciation, and the remuneration, fees, residual interest, tax benefits, synergy benefits, saving in the cost, and the economies of scale. Right? This all we take into account to work out the return and see is it variable, which can be varied because of the power of the investor or by for directing the relevant activity of the industry. Okay. So exposure to return is a strong indicator of control, but it's not total one factor. It is a strong one of the strong indicator of control. So we need to reassess if the fact and circumstances there may be there are three criteria of control. We continue to watch. There could be a change in future, like change to how activities are directed through agent, maybe through someone else, and maybe nationalization taken place. Now your ability to direct activity is no longer there, and could be change in exposure to the variable return. The variable return exposure is reduced. It's not now that materially variable. So in that case, we have to then determine whether control is there or not, still is there or not. If it's no longer there, we should stop consolidating. So could be we gain the control during the period of the business. Maybe earlier we had 45%, and then we have also 15%. Okay, it come to 60%. Okay, so we gain the control. Here control was not there. Now control has come. So we already discussed when we're looking at the IFRS 3. In that case, this 45%, the already we have to bring it to fair value and book a gain or loss. Okay. Then the new cost plus the fair value of 15% new cost and fair value, that together come with the cost of acquisition of the 60%. So after this point, we need to consolidate. It could be start of a year, it could be right in between the year, middle of the year, and maybe a part of the year where we gain the control. But combination start from that date onward. We call it date of acquisition. If we lose the control at any time, we need to cease the consolidation, and we should recognize the remaining retaining the part at the fair value. Like we had already 60%, we sold 20%, we left with the 40%, and we got the 40%. One is we stop consolidation. Second, at what amount we will take the 40%? The answer is at fair value. Okay. Now we come to the any point so far? Okay. Then whenever you consolidate, so you consolidate, when you consolidate, you make sure there is a uniform accounting policy in the accounts. Like parent policy should be reflected in the subsidiary accounts. Like let's say the parent has a FIFO method of inventory measurement, and whereas the subsidiary has average method of. So we need to change the subsidiary accounts by incorporating the effect of use of FIFO method in lieu of instead of the weighted average method. Right. So this is wherever the gap in policy, we have to follow the a policy of a parent company and adjust the subsidy accounts with that difference, and then we should consolidate. Okay. So a parent need not to present the consolidated financial statement if it meets all of the following conditions. We did discuss these as well when we were looking at the equity method. The same applied to equity method as well. When they give you the exemption from applying the equity method, same was there as well. It is a wholly owned subsidy, which is not to be included, and it's a partially controlled subsidy. The only difference is in the wholly owned subsidy, you don't have to do any further, but in case of partially owned subsidy, you need to inform the other shareholders that you are not preparing the consolidated account and none of them has raised any objection, right? You have to warn them, you inform them. And second, the parent is not presenting consolidated financial statement, which is seeking the exemption. Its loan or its equity is not publicly traded on any exchange. And third thing is, this company, which is not preparing the consolidated accounts, is not in the process of filing its financial statement with any security commission or other regulatory organization to seek the permission to issue in public market its instrument may debt or equity. And fourth one is the ultimate parent company or intermediate parent company is preparing the consolidated account by applying the IFRS. Like I give you the example, like there's a company H, there's a company S, there's a company S1, there's a company S2. Now, how many parent there? This is the parent, this is the parent, this is the parent. Okay. And now let's say this company want exemption. So we will look at the first condition, second condition, third condition. Then look at the fourth condition. We say whether the ultimate parent, which is H, or intermediate parent, which is the S. Either of these, we should have been preparing the consolidated account by applying not the American GAAP, rather IFRS. So then we can give exemption. If they are preparing the consolidated account, but not as per IFRS, then the exemption is not available. So either has to prepare the consolidated account, and they also have to be prepared as per the requirement of IFRS. Okay, so then all these four conditions, if you meet, you can that entity not need to prepare a consolidated account. Like this entity does not have to prepare a consolidated account if these four conditions are there. Okay. Okay, there's the exemption for investment entity from consolidation. Okay, what is called the investment entity? This is the first thing. There are three conditions. First is that entity obtain the funds from one or more investor for the purpose of providing those investors with the investment management services. They do the investment on their behalf, they handle their investment, they disinvest, they invest, they collect dividend, provide this kind of service. Okay. And that entity commit to its investor that its business purpose is to invest funds solely for return from capital appreciation, investment income, or both. This is their objective. And third is that entity measures and evaluate the performance substantially of all its investment on a fair value basis. Like they want to see how they are performing, how good they are performing. They have to bring all those investment at fair value and see over a period whether there was a decline, whether there was an increase. They look at from that perspective. So that's called the investment entity, whom we want to give exemption. Okay. So we are saying the entity, which is investment entity, we have to assess whether that is the investment entity. Once we are satisfied, by looking at the design, purpose, and facts and circumstances. We all have to look at those things, and we have said yes, it is an investment entity. Okay, so IFRS 10 provides an investment entity should have the following typical characteristics. It should have more than one investment in other entity. It has more than one investor, which are providing them the fund for the investment management. And those people who are providing those the entity which are providing the funds for investment are not related entities. And it has ownership interest in the form of equity or similar instrument in the companies in which it is investing, right? So these are the main characteristics. But it is being said that absence of one of any one of these does not necessarily disqualify entity from being classified investment entity. You have to look at other facts and circumstances, purpose and design, and then you say, okay, in view of that, even this particular is not meeting, still is investment entity. Okay. Okay, IFRS 10 contains special accounting requirement for the investment entity. Where investment entity meets the definition of investment entity, as we already discussed, it does not consolidate subsidy and also does not apply IFRS 3 business combination. So when it's obtained the control of other entity, rather this investment entity required to apply the fair value through profit and loss. Okay, this is what is required. IFRS 9, fair value through profit and loss. However, investment entity is still required to consolidate subsidy where that subsidy provides services that the investment entity's investment activity. You see, this investment entity has various subsidy, right? But that subsidy are the investment subsidy, okay? But if the subsidy just providing the service like advisory, analysis, this kind of thing, support service, that is not exempt from inclusion in the consolidation. Okay, so that will still need to be consolidated. Okay, because the investment entity is not required to consolidate subsidy. So when you don't do the consolidation, you don't exclude the intergroup. You don't eliminate the intergroup balance. Don't, because when we only offset or eliminate those whenever we consolidate. Like in equity method, when we apply, we are not consolidating. If there's any the balances payable, receivable from each other, investor and investee, which have the relationship of associate or joint venture, we do not eliminate those. Do not cross out each other against each other. It's only in case of consolidation. Okay, the exemption from consolidation only applies to the investment entity itself. Accordingly, its parent of the investment, its parent is required to consolidate all the entity that is in control, including those controlled through an investment entity. Subsidiaries of the investment entity, they also be a parent company is not exempt from that, unless parent itself is a investment entity. Then the investment entity exemption will be available to parent as well. Okay. So that's a very important exemption they have brought after the issuance of the IFRS 10. Earlier, this was not there, but still 7-8 years has passed since this has come into. How we do the consolidation? That's the next thing. It's a very important slide, actually. What we do is we combine all like items of asset, liability, equity, income, expenses, cash flows of the parent with those of subsidy. Like if we have a plant, we have a like item, plant with the plant, land with the land, vehicle with the vehicle, overdraft with the overdraft, long-term loan with the long-term loan, revaluation surplus with the revaluation surplus, income sales with the sale, interest income with the interest income, interest expense with the interest expense, administrative expense with the administrative expenses. That's what we do. Okay. Offset and eliminate the carry amount of parent investment of subsidy. Remember, I substituted 150,000 investment in the company with the various figures, which was assets, liability, non-controlling interest, gain, GBP, and I substituted with that. That's what they're saying. Offset eliminates the carrying amount of parent investment in subsidy and parent portion of the equity of each subsidiary that has to be adjusted so that we can work out the goodwill and recognize non-controlling interest. And we have told you there are two basis of working out the non-controlling interest. Already we discussed that. Eliminate full intergroup assets and liability, payable, receivable. As I said, when you consolidate, you have to do that. Wherever transaction between the entity, those transactions are netted off, excluded. When we don't consolidate, we don't exclude them. Similarly, there could be a unrealized profit on certain transactions which are still in hand. So that also to be not have to be adjusted, has also to be adjusted. Like inventory, one entity sold the other entity the 5 million worth of inventory, and 1 million is still in hand. So gain earned on that 1 million. Other 4 million, no issue because it had been sold out, and so you don't have to make an adjustment. But the inventory in hand, there's the unrealized profit part of that. We have to eliminate that. Similarly, fixed asset, ये किसी का फर्क आपका ऑन है माइक फरक अनवर साहब का माइक जरा म्यूट कर दें प्लीज ओके. So fixed assets similarly has been sold by one entity to other entity, and they earn the gain. Are that also not to be included? That has to be eliminated because that's unrealized gain. Asset is still with us, has not been passed to the third party. And the reporting entity include the income and expenses of the subsidy in the consolidated financial statement from date it gained control. I already told you. As you consolidate by taking income expenses up to the date, from the date you gain the control, and up to the date you lose the control. We already discussed that. Okay, this is very yellow point I said is very important. Income and expenses of subsidy are based on the amount of the asset and liability recognized in a consolidated financial statement. I give you the example. When you make investment in subsidy, and you need to work out the fair value of the subsidy to work out the goodwill. But sometimes subsidy itself, but most of the time subsidy itself does not recognize in their financial statement that change in the value of the asset because that was just for consolidation purpose. Now you have a fair value is 100 million, but the carrying amount is 70 million, 30 million difference. When you work out the goodwill, you work out the goodwill on the basis of 100 million because this was the figure which was taken into account when we work out our goodwill, and we decided to incorporate those assets of subsidy into our accounts. Okay, that's why I say the expense should be based on the amount of the assets and liability recognized in the consolidated financial statement at the acquisition date. Okay, this is the basic principle of consolidation. Okay, reporting period should be matching, and if it's not matching, you have to prepare a special account so that the date, the subsidy account should end at the parent date. But sometimes it's not practical. So if it's not practical, then you can use the accounts of a different date of the subsidy with the parent, different date, right? But remember, the difference should not be more than 3 months, even in that case. If there is a more than 3-month difference, then you have to prepare the special account ending on the date when the financial statement of the parent are, year end date. You have to do that. Okay. So we did discuss this as in equity method as well. Okay. When we were looking at IS 28, we did discuss that at that time as well. Okay. Now, non-controlling interest, and already I told you, non-controlling interest in consolidation account can come as a percentage of fair value of net asset at the date of acquisition, or fair value of the non-controlling interest, the date of acquisition. That is either option is available, but has to be disclosed as a part of equity of the consolidated account, but separately. Okay, separate to be disclosed. You should be able to see on the consolidated financial statement the amount was non-controlling interest. Okay, reporting entity attribute profit and loss. There's a profit and loss other comprehensive income item of subsidy during the period. Okay, profit and loss and other comprehensive income item. So we need to attribute that how much is relating to the owner of the parent and how much is relating to the non-controlling interest. We have to. I'll show you in a numeric example. Okay. Okay, and that allocation of basis of present interest, okay, not future interest or past interest, present interest. What is the present percentage is using that. Maybe over a period we acquired more, has changed, and the maybe we sold some and reduced. So as a parent, present percentage we use. Reporting entity also attribute the total comprehensive income. I mean, total comprehensive means net profit for the period and other comprehensive income. There's a total. Okay, we also allocate that how much for the parent group, owner of the parent, how much for the non-controlling interest. We also have to. I'll show you that. Okay. Non-controlling interest figure will be there, separately shown. Even it is a negative figure. Even it's a negative figure. Remember, under the equity method, we say our investment can not go to a negative figure in equity method. But here, non-controlling interest could be negative, right? There's no exception to that. Whatever is, that should be there. That should be attributed and disclosed. Okay. Change in the ownership interest in the subsidy, which may result in the no loss of the control. Like you was having 80%, you sold 20%, you still have 60%. Okay. So there's no control. You will still consolidate, right? And but the 20% we sold, whatever the gain and loss on that, there could be gain, could be loss. Gain is difference between the adjustment of the net asset relating to the minority interest, non-controlling interest, and the amount we received from them. There could be a difference. At that difference, the profit and loss. So they say, if there's a profit and loss, it will be treated as profit and loss on the transaction between the owners. And if there's a gain or loss on the transaction between the owners, then that place is a statement changes in equity, not profit and loss account. So we should take directly to the statement of equity rather than taking it as a gain or loss in the profit and loss account. Okay, where we don't lose the control. I'm talking about that case. 20% the net asset, which will be increasing in the minority interest, and what minority has given to acquire that 20%, because minority interest is no longer 40%. Okay, 20% it go to 40%. Okay, so then we say what they have paid, what are the difference? That's a gain and loss. But the point is, it is a gain and loss, but it will go through the statement changes equity, not through income statement. Okay, the control is lost. In that case, you should stop doing the consolidation. You should de-recognize all the assets and liability of subsidiary company. And whatever, like you had a 80%, you sold 40%, you left with the 40%. And this 40%, assuming not giving you the control. Okay, in this case, this 40% will be reflected at fair value. Or I already discussed that, fair value. And this fair value, which you work out right at that point, is the starting fair value if you are applying the fair value method of measurement on the investments, I mean, simple investment I'm talking about, okay? Or it can be a cost, because this 40% may turn into, with the 40%, it could be a simple investment, it could be the associate, significant influence. So remember, if it's significant influence, still you have been told, in that case, you apply the equity method, right? But if it's a simple investment, you are told that there is a two method. One is a fair value method, right? But you are told here, if you apply the equity method in simple in those separate accounts, you have three methods. One is the cost, other is the equity, third is the IFRS 9. If you are applying IFRS 9, this value which you work out right at the date of disposal become your fair value as a starting point. If you are applying the cost method, then it's become your initial, this fair value is your deemed initial cost. Okay, that this will be continue to apply in all cases because it becomes a cost. Okay, so that's why you have work out the fair value. Then if you are applying the fair value method, it will be your starting fair value. If you are applying the cost method on the investment, then it will be your cost. Okay, and the whatever gain or loss on that selling 40%, that will be through profit and loss account. This is your gain or loss, whatever. Okay, there's no disclosure in IFRS 10 because I already told you all disclosure have been shifted to IFRS 12. Okay, so now this IS was applicable in 2013. Even and you were required to apply the retrospective application as just like correcting the error under IS 8, in which cases could be with the new definition of control, certain entity which were not previously being consolidated now need to be consolidated under the new IFRS because the control definition has changed. Could be certain entity which you was considering they need to be, you were consolidating, but with this IFRS 10 control definition, they are not having the control there, and so not need to be consolidated. So this adjustment was required to make in first accounts, required to be made in first accounts, but as an effect of the error, right? Prior adjustment, whatever. Okay. So this is the IFRS 10. So we can just look at if someone has any question before we move to the next to IFRS, because we have sufficient time.
Assalamu alaikum, Maqbool sahab. There are a few questions on the chat box. If you just can take a look and address them.
Okay. This is first is company has a convertible share option in a company with ownership of less than 50%. Does it has to be included in the convertible share in consolidation? I said if currently exercisable and there's a practicality of exercising and there's a substantive right under some instrument, yes, you can do that, but should be currently exercisable. I given you the example. I think you might have written that question before looking at that point, but this is my answer. Does that mean control will keep fluctuating based on the market condition, market price in excess or below the exercise price? No. Cost of investment is the same forever. Okay. And what a percentage you acquired is the same forever. So no, it's not, it will not keep on changing. The point is, I said negative or positive. The variable return would be due to change in price, negative side or positive side. But it only affects your, it only gives you the variation level is there, okay? But it will not change the control. It will not change the control, right? Okay? Control will change when circumstances change, like nationalization take place, and maybe there were 52% share were widely dispersed. Now some shareholders acquired from the market those shares and become a bigger sizable shareholder, one or two, and they can act together. At that time, your control will be lost. Okay. Okay.
Just one question, sir. So it means if
Yeah.
the options are out of money, even though they give me control, but they are far, far deep out of money, I still need to
Yeah.
consider them from control calculation perspective.
If it's out of money, then you will not going to exercise that. Isn't it? Practically, you will not be exercising that. If it's in money, more likely, and the date is there, and you can exercise, that is the money. In money, you can exercise, so you will take into account. Otherwise, because it's not practical with the loss, you are going to exercise that option, so that then it won't be included. Otherwise, it would be included.
Last question, sorry for dragging. So it means we
Yeah,
need to continuously evaluate what we think would happen, even though they are in money, out of money. So
yeah.
some sort of a judgment is involved, you're saying.
Yeah, like you see, when you are holding 40% and it is out of money, you will not in that period, you will not consolidate because it's not practical. You will exercise those rights, and maybe 2 years before the end date of exercising the right end point, before it comes, and before that it come to money, practicality comes there, and you can go for that. Then in that 1 year or 2 years, you will may start consolidating.
Thank you, sir. Thank you.
Yeah, thank you.
Maqbool sir, one more question before we move on to the next one.
Yeah.
Kareem Mehboob has asked, what is the criteria to assess presentation of share of profit or loss in associate of joint venture in the statement of profit or loss? Is it either part of
Uh,
operating profit or non-operating profit?
Total profits. Because in that equity method applies, you see, in that case. Equity method says you will be having the share in the net profit of the entity, your share, and your share in the other comprehensive income of that entity, your share there, and that total whatever come, like you already made a investment cost 500, and your share of net profit and net profit, whatever go to profit and loss account. We're talking about that thing. Okay, whatever go to profit and loss account, and whatever go to profit and loss account, other comprehensive income, that percentage that come to total come to 70 the net profit share, and 30 the other comprehensive items share. I'm saying share percentage of share, and total come to 100. That 100 will be added to 500. If no dividend is given, then your equity method will be 600. If dividend of 50 is given, then 50 will be reduced from there, and 550 would be then the equity method amount there. Is it clear?
Just want to ask one thing. Like we have seen in the market, the practice that the share of profit in JV or associate and the profit and loss, some companies present it above operating profit line, which is part of operating activities, and some companies present
Oh,
after operating profit line. So, what is the
yes.
criteria like in terms of presentation of the share of profit?
Unfortunately, the IFRS have not defined the operating profit. Okay, they have not defined, but they were looking at defining the operating profit. Okay, otherwise this is not defined there. So, but operating profit is considered to be the before the financial cost and before the income which not relating to your activities. Okay, because otherwise you say other operating income, you take it on the upper part. If it's the other operating, but say the non-operating income come to lower part. But if I believe that entity is of same nature of business, okay. So in FD method I'm talking about, not in consolidation. In consolidation, you don't look at the difference in the nature of business. Okay, so there you may say, I'm insurance business. My that the entity in which I have investment, which is my associate, is not insurance business. So you might not show as a part of the operating side. You take it to non-operating side. Okay, so that's you have to elect the policy for that, and you have to disclose in your notes properly why you treat it as operating, why you treat it as non-operating, something like that. Yes. Okay.
Also, I think we can move on to the next IFRS. Yeah. Go ahead.
It's not IFRS yet. I have to go to a little example
Sure,
to
definitely.
clarify certain figure work. Okay.
Done. Okay.
Here now, let's say. Okay, group accounting. Remember, I shown you this slide when I was looking at my last thing. There are two balance sheet, HRS, their own balance sheet, and now we want to apply the consolidation. There are certain things, individual company adjustment you have to make. They are the 5 area I discussed that. Item not accounted for, like you have not made a provision in a company as say some provision is missing. You do that provision in that. Okay. You haven't provided the impairment in H that has to be applied. Okay. And the group policy adjustment, group policies are not uniform. You have to adjust the S share for the S account first for that before you start consolidating. Unrealized profit is there, right? So you have to adjust the unrealized profit. You may have to reduce the stock figure and have to increase the cost of sale figure for that. Okay, in this way you make that in the individual company that also. And then the fair value adjustment, like the asset of HRS are being brought to the fair value through revaluation or normal fair value method. You change that. I made a wrong cross here. Maybe in the asset you brought it to fair value. A certain liability you brought it to fair value. You have to bring them first. And maybe one subsidy is in a foreign currency. There's a foreign currency operation. To convert them to your Canadian dollar first before you start consolidating. I'll look at the consolidation in a minute. And when you do the consolidation, you need to work out two things, goodwill, and you need to work out non-controlling interest. And also you need to work with consolidated reserve. A consolidated reserve is basically holding company's own reserve plus their share in the post-acquisition reserve of the subsidiary company. We'll talk about that. So this is a major consolidation. Then there's a cosmetic thing like cancel the intercompany balances. One company owe the other company. So one has in the receivable, other has in the payable. You cross contra them before you in finalizing the consolidated account. This is what we discussed in our last class. Okay, I'm going to apply this today. Okay, let me straight away go to the example. I'm going to do this here, but I've put the step here as well for you people, and let me go through. Like what is in this is actually the first part is how to against the cost of investment. You have to make those entry which I shown you today in the beginning that instead of under 50, there will be replacement of other figure. There will be separate presentation of non-controlling interest. We discussed that, and we said the controlling interest would be non-controlling would be coming as the percentage of fair value, adjusted fair value, or could be the fair value. Okay, that's there. Okay, then we have to exclude the intercompany balances and the profits, unrealized profit as well. I spoke about that. So that's what all that is. Calculate the goodwill, and then that goodwill is presented in the consolidated balance sheet, not amortized, rather check for tested for impairment at each year end. Okay, And if it's a new subsidy, consolidate from the date of you acquire the control. If it's a you dispose of a subsidy, then only consolidate up to the date of disposal and not after that. Okay, that's what we already have discussed. And here I want to discuss with you. Let me shift this thing to this side. My picture is stopping me. Okay. There's a year end is 30th June 2022, and you are given the three accounts, income statement of three company. One is the H Limited holding company, the other is subsidiary, and other is A Limited, right? It could be simple investment, it could be associate. Okay. But I'm taking it as associate. Okay. And we are told each company sale, each company cost of sale, each company admin expenses, selling and distribution expenses, financial. Only one company is the interest paying company, and subsidy is not. Associate is also interest paying company, and there's a tax, and there's profit after tax. Let's say there's no other comprehensive income. Had there been any comprehensive income, should have come at this place. Okay. Then in order to reduce the size of question, I brought here the profit brought forward from previous period. And this figure then come, which is a carried balance sheet of each company. This is there, okay? And then we have the share capital of each company. We have a reserve of each company at the end, that date, which we mentioned there, which is 30th June, I think 2022. Yes, 30th June 2022. Okay, then we have the long-term loans of each company. Then we have a fixed asset of each company. Then we have investment. One is 80%, that's in the subsidy, and then the 25%, which is in the associate. And then we have a stock of each company, okay? And then we have a other net current asset of each company. In this way, we have a balance sheet balance. This is in front of us. And we are told other information is at the time of making investment, I mean on the date of acquisition, which was 1st July 2018, the reserve of H Limited and S Limited was 200 and 100 respectively. We call it pre-acquisition reserve. Reserve as the date of acquisition, we call that. Okay. And then during the year, S Limited made a purchase from the H Limited, which is called intergroup transaction, 500, right? One has a sale of 500, other has purchase of 500. So we need to eliminate that intercompany transaction. And also, out of this stock, which is purchased 100, is still in the stock. H Limited is charged 25% profit on the sale value. So if it's a 100, then 25% that comes to 25, which is the unrealized profit. We have to deal with that as well. Okay. So this is the case in front of us. Okay. Let's say what I'll do is I'll take the sale of. I'm not bringing yet. I'm not talking about the A Limited yet. Leave it out for a minute. Sale of parent company, sale of the other company, and then we eliminated 500, which is intercompany sale. Then this is the cost of sale given. This is the cost of sale given. At 25, remember I work out the unrealized profit in the stock, which is 25, which will increase my cost of sale. When my closing inventory will reduce, my cost of sale will go up. And second effect will be an inventory figure, right? We have inventory of HS, and that would be also need to brought down because it is at 100. We don't want it at 100. This should be 75. The second effect will be on the inventory. Okay, that's what we made. Okay, as a result, here you can have a sales, the net sales, cost of sale, and then this a gross profit, and then the admin expenses both are added, then selling distribution both are added. I'm just picking it from the question. Okay, then the financial expenses is only one, not of S. We added. Okay, then we have a tax of both company, which are each respective. Tax figure will not change because tax is always paid on a basis of separate accounts. The total is this. Okay. And now this is the profit after tax. Okay. Now here is a point come. Out of this profit of subsidy, 20% belong to minority, which I have reduced from this column. Okay, I have reduced this column. Okay, this is straight the cross costing, nothing else. Cross costing. Okay, that's come there. It reduced here, come to there, the minority interest, and then we have the group profit for the respective. This is for the year. This is a group profit. Okay, this is a group profit, and I will not talk about the age yet. Okay, I'll leave it at the moment. And then we have a brought forward profit. This is exactly from the question 440. This is the question. I can show you there. This 440, right? And now this 280 is also brought forward of Hassel Limited. Remember, in this 280, 200 is the date of acquisition. That's the brought forward. 80 is the further which was added during the period till the start of the year. Remember this distinction because we are given this information that 200 was the date of acquisition. Okay. So on the basis of that, I just move forward and bring it here, here. Now 200 will be, there was, I told you there's 200 and there was 80 in the brought forward. This 200 will go in the working of the goodwill because this is a net part of the net asset rate of acquisition. This was after that. So my share in this is 80% here. Group share is 80%. This comes here. Okay. Now rest is just cross cost, nothing else. Okay. You can see your group profit is this. Okay. This is a group profit. I need to prepare the profit and loss account. I will just pick up these figures up to this. This is profit and loss. And my analysis is out of this much belong to minority and this much belong to group. That's, I told you, I have to bifurcate this figure and this is being nicely bifurcated. This is non-controlling interest related and this is the group related. Okay. This is there. This is just profit and loss. And this is brought forward. This is statement changes equity. This is brought forward plus for the period and this give me 1370%, nice figure. Okay. Now I'm going to balance sheet. Okay. Let's go to balance sheet. I'm skipping this at the moment. I'll come back to this because this is giving me all that and I'm just copy that. Believe me, up to this, look at back. Okay. I'm just going to copy this the big box here. Okay, I'm copying it. It's here. I copy the big box. Okay. Oh God. This big box. Only thing I'm not discussing that because I wanted to deal with the equity method as well. That's why I said no need to talk about the rest at this moment. And this is the text. Okay, this box came to my calculation. Okay. These two things I'm not discussing at this moment with you. I straight away copied that from that. Okay. So now I go to balance sheet. The balance sheet, I have to work out the goodwill first. Only thing is the goodwill. You know the cost of investment. We are given the cost of investment. How much was the cost of investment? Here. 2500. So I prepared this adjustment account. 2500 my cost of investment here in this side. Non-controlling interest, which is basically share capital plus pre-acquisition reserve, which come to 2020. And the 20% of that is the non-controlling interest. They are not bringing the fair value, rather they are taking the percentage of the fair value net asset, fair value of the net asset at the rate of 20%. And the difference the goodwill, which will go to balance sheet. I'll show you in a minute. My consolidated reserve is 1000, which as per the balance sheet of H Limited, because I told you the H total reserve will come here. This is reserve. But when we come to taking the reserve of this, we only have to take post-acquisition reserve. Okay, we'll go to that. Working on the post-acquisition reserve. Okay. 700, you saw there. 200 is the pre-acquisition. Post-acquisition, 500, 80% of that come to this 1400, the consolidated reserve. But this is the adjustment of inventory gain in hidden in the inventory or incorporate embedded inventory. This is, and you can see this is the figure which is tying up with your profit and loss account, because there we have already done that working. Okay, this is one. Okay, so I was not supposed to prepare the consolidated reserve calculation, work out the consolidated reserve, because it was readily available to me in the profit and loss which I prepared. But if you are not preparing profit and loss account, I was showing in that case, you have to work out that. That is there. And this is the adjustment of inventory. A second adjustment of inventory would be the stock. If you see the stock, which is 1500 of both companies. Here, 1500. But 25 has to be reduced, right? So therefore, 25 effect would be there. Okay, so stock is this, okay. Now, non-controlling interest, whatever the current net asset of the company, 20% of the act. That's a straight, very quick calculation always. Because minority interest means whatever the net worth today, 20% that. Okay, now this is the parent company share capital. This is the consolidated reserve, this one. I'm not touching the 25 yet, okay? And this is the non-controlling interest. And this is the add the long-term liability of both companies, add the fixed asset of both companies straight away, bring the goodwill there, and bring the investment cost which is given in the question. I'm not dealing with the other figure, and this is the other net asset. Okay. If I exclude this 25 and this 25 and rework my figure, both sides will balance. Okay. With the difference into 25, because I'm not taking this in 25. This 25 is because of the equity method. And now I can show you the equity method as well. Okay. Let me go back and show you the equity method. Okay. Okay. Here's the cost. Okay. I have to apply the equity method. Equity method is applied here in the profit and loss account. What the equity method is? Share in the net profit before tax of associate. Associate made a profit of 100 as per question. And this is 25% that. And tax is the 30 in their account. 25% of tax is this. And this is a resulting figure. This is this minus that resulting figure. Okay. And that same figure here. Okay. So that's the two things we brought here. In equity method, we have to give a share of the sometimes people take a net profit share, okay? But I say tax should be shown separately and the profit before tax should be shown separately. So you do it separately and it shows you there. Okay, for a minute, leave this forward, brought forward one at this moment, okay? Let me go back to your profit and loss account, which I brought 25 here, which I ignored earlier. I brought 7.5 here, which I ignored earlier. With the tax, associate tax. With the net profit before tax, the associate profit before tax, okay? And this is my figure. This is my figure. Okay. And I have to do the analysis of that. How much belong to group and how much belong to non-controlling interest. Non-controlling interest is, I know from my previous page analysis, that's a 84. The rest whole is of the parent. The rest whole is of parent. So out of this 792, this is a minority and the remaining is a group. Very nicely, you can reflect that bifurcation, attribution, allocation, you can present that, okay? And now I go to the balance sheet, okay? The balance sheet is only one thing. Just add 25. What is 25, okay? What is 25? 25 is basically, just 1 minute with me. Look at that. The reserve was 200 current. and the date of acquisition was 100. The difference between both is 100. Increase in the net asset is 100. This 125% belong to the investor, right? 25. That's that 25. Okay. So that 25 is a double entry you make. Double entry here, double entry. One here, this here, add that, and second add to the investment. One add to the reserve, second. The equity method is applied. It's also called one-line consolidation method, equity method. Okay. So if I show you in profit and loss account, so I have shown in the profit and loss account, but I can show you also the reserve, how it meets there. If I bring here brought forward, what the brought forward? Brought forward 30. If you look at the question, the brought forward would be 130, 130. And let's go to that. Here, 130. One at the date of acquisition, 30 is the post acquisition. As I bifurcate the 200 and the 80, same way this is that. We're talking about this one, which is a brought forward, belong to the profit and loss account, brought forward. So this is 30, 25% of that comes to. So I added that. In this way, you can see this is 1375 plus 25 that I was showing in the balance sheet. Okay. So that 25 is making the double entry basically. One, adjusting the reserve here like 1375 plus the reserve 25. And second, the investment is getting affected with that 25. Okay. So this is the way you produce that. Okay. I will share with you these notes, and in your time, please go through this statement changes equity. It's not a rocket science. It's just like brought forward. This is brought forward, share capital of the parent company. This is retained earning brought forward. Okay, I'll show you. I have already worked with that. Brought forward. Point is the brought forward. Okay. This is the brought forward. That okay. 504 plus 7.5. That becomes 511.5 brought forward. So this is the brought forward going there, and this is the total of both. And this is the minority interest brought forward. This is at the date of acquisition. I mean, 2200, 20%. Already we did it when we were got the goodwill. And the remaining is 280 minus 200. 20%. 16 is coming here. 64 already we taken in the accounts. 64 will belong to the group that already have taken there. And the 16. This becomes 5. This. Okay. That's the total of brought forward equity method. The other is very simple. Already I have this bifurcation available with me. Like look at here, this. I just brought this to my that column. Okay. And it's there. And exactly everything tying up with my balance sheet there. Everything. My reserve, share capital plus minority interest come to 5940. And the balance sheet you can take it there. Yeah. Okay. So this is also how you prepare statement of changes equity as well. Okay. I tried my best to brought here very simple way the example to cover the whole mechanism of this consolidation. But I'm sure after going through this way, when you will have these slides in front of you, I'm just thinking that I should have shared this slide earlier. So you people should have been in front of you. So when I was saying how much in the profit and loss account brought forward figure, you should have been able to see that. But I'm sorry, I failed to share earlier, but now it will be shared with you and you can look at that. So that's the consolidation calculation. Before I move to the IFRS 11, any question on that? I've just done after taking the previous question, I've just did one exercise with you and reflected here the mechanism of consolidation and applying the equity method.
Maqbool sir, we have a question from Farooq Anwar. When we consolidate with a foreign company and translate the balance sheet, where does the this forex adjustment, where does
Sorry,
that? Yeah, Farooq, you can
a
go ahead
little
and
bit
elaborate.
typo in there. Yeah, a little bit typo in there. So basically, when we translate, so when we consolidate a country, let's say,
Just a minute, brother. Just a minute. Let the other person complete his question. I'll take your question.
Farooq, Maqbool sir, Farooq is elaborating on his question. Yeah, Farooq, go ahead.
Acha, okay.
Yeah, this is my question.
Yeah.
So
Okay.
Maqbool Saab, when we are consolidating foreign a company in a foreign currency, translate it into Canadian currency, let's say. So the foreign exchange adjustment, where does that go? Does it go into the OCI? And then, so that's my first question. Like, how do you treat with that foreign exchange adjustment? And then, so next year when we consolidate it again, then now the same balance, if it's not changed, now we are translating, converting again, but the exchange rate is different. So now that exchange difference, where does that go? Does it go into open retained earnings?
No. Every time you make the consolidation workings fresh, there's no bookkeeping done for the consolidation. You put in front of the new balance sheet, new profit and loss account, translate them, and your figure change. That figure change go to other comprehensive income, right? Okay. It's not previous figure was that, and you are taking it up or down. This is not the case. You rework as a new gain on translation, a new loss on translation, less or more comes in, you put it there, OCI, okay?
Okay,
this is my answer.
All right, thank you so much. Thank you so much.
Yeah, okay, thank you. Okay. Okay, so if any other question?
I don't see any on the chat window, Maqbool sir. You can proceed.
Okay, good. So let me check the time. It's nearly we have 1 hour as per our schedule. Okay, no issue. We will do it in time. Okay, don't worry. Okay, and joint arrangement, you see, joint arrangement. Here few definitions. Look at that. Already told you that joint arrangement is basically where there can be two types. One is the joint operation, and the is joint venture. If it's a joint venture, IS 28 applies. If it's a joint operation, then this IF would apply. Okay. Stay attentive, very with the focus attention. You see, we will be able to do it with a great understanding. Okay. So point is, joint arrangement is we already discussed where we have control with the one or more party. Okay, that's a joint arrangement. Okay, so and if then there's a distinction between joint operation and joint venture. I'll talk about that on my next slide, not at this point. Okay, so a joint venture is a joint arrangement where the parties have the control of the arrangement, and okay, this distinction is there. Okay, joint operation is basically where the investor party, which have a joint control, which have a joint participation, they have a right to the assets and obligations or liability of the other entity. Okay, but in case of a joint venture, the investor has the right to the net asset of the joint arrangement, not the assets, right, and obligation for the liability, right? So that's the basic distinction which we'll keep okay, there. The difference between the both is basically the right to net asset in one case and the right to assets and liability, right to asset, right to obligation in other case, not in the net, okay? So the difference is the separate vehicle, Okay. If there's a separate vehicle, then normally you have the, normally, I'm not saying always, normally you have the right in the net asset of the entity. Like in a subsidiary, in associate, we had a right in the net asset. We looked at the change in the net asset there. We never look at the individual assets there, okay? We didn't look at how much inventory gone up, how much fixed asset gone up, how much long-term loan up and down. We don't look at that, okay? That's the thing there. So, okay, whereas joint operation is mostly contractual and mostly, I didn't say always contractual. Would be separate entity here as well, okay? But look at the difference. It's always separate entity, okay? Joint venture, always separate entity, right? And the joint operation is not necessarily there's a separate vehicle. Could be separate vehicle, but if there's no separate vehicle, then it can never be joint venture. For joint venture, it has to be separate vehicle. What kind of separate vehicle? We will be looking at that, okay? Okay, the control is joint, a definition of control is already we know, okay? And that's the 3 point I already discussed today, okay? And the IFRS 10 goes on to say that if when two more investors who have collectively control, an investor must act together to direct this activity. And if like 2% have, in case of joint control, no single person has that control on the activity. Individually, they don't have. They have to cooperate with each other, and then they can have a control. Right? Each investor then would account for the interest investment according with the IFRS 10 joint arrangement. We'll talk about joint arrangement where the joint things are there. Okay, that's a joint arrangement where two or more investors who collectively control an investee must act together to direct the activity because no single investor can direct the activity, needs the cooperation of other as well. Mostly it is covered under the contractual arrangement. Okay. So this is there. So it could be, and it could be accounting for the as a joint arrangement, which may result in a joint venture, and so the IS 21 may be joint operation. So the IFRS 1, 10, 11. Okay, so let me stop for a minute and tell you, joint arrangement will result into either joint venture or joint operation. If it results in the joint venture, earlier, we only talk about joint venture, okay? If joint venture apply the equity method, we didn't say how we will determine the joint venture. Here, we will be looking at the determination of joint venture as well. Once it's a joint venture, of course, accounting is already discussed, okay? Few additional things will be discussed here, okay? If it's a joint operation, then IFRS 11. What IFRS 11 says about? Okay, let me say, okay. If it's they are in an entity, they are 4 parties, okay? Here. I should have put A, B, C, okay? A, B, C, D. Okay? They hold 100% together. So they are 2 or more. Okay? But could be these 3 has a contractual arrangement. Okay? They will be joint venturer or joint operator. But this is a participator. This is a participator. Okay? So we will be talking about the accounting by the joint venture, joint operator, and participators. Because in joint venture could also be participator. And in joint operation could also be the participator. So we'll talk about how both should be doing their accounting. Okay, that's what. Earlier we only talk about whoever has a joint venture, they should apply equity method. Here we'll talk about various kind of proposition as well. Okay. Okay. So you need to assess. You need to assess first, make the assessment. whether there is a joint arrangement or not. Okay. The joint arrangement is where two or more parties have a joint control. A joint control means which contractually they have to have a unanimous consent to direct the activity. Okay. A, B, C, D, they have a unanimous consent required of them, not of D, A, B, C, not of D. Okay. So joint control is with A, B, C, not with the D. Okay. Okay. And now it's a joint operation. So joint operation is when in the other entity you have a right to the asset, obligation to the liability, maybe 30%, maybe 40%, right to the asset, right to the liability. Okay. Joint venture is where you have the right to the net asset. This is the basic difference between the operation and the what you call it, the joint venture. Okay. A party to the joint control is a joint venture. A party to a joint arrangement is that participates in the joint arrangement, regardless of whether the joint control is there or not. We call them the party to the joint arrangement. A joint arrangement with the two or more party have control, not joint control, control. Okay. And then who have the joint control, right? They are separate, other is a participator. Separate vehicle is where entity owns has identifiable financial structure, separate legal entity from the investor under a law, okay, and the legal personality. Whether the entity, regardless of whether it's legal entity. A company has a legal entity, but a partnership doesn't have a legal entity, but that is a separate entity too. Okay, that is a separate entity too. A general partnership is an entity, separate entity, but not a separate legal entity. But company corporation is a separate legal entity. We are going to talk about all that. Okay. Let me. Okay. Okay. So a joint arrangement is an arrangement of which two or more parties have a joint control. A joint arrangement has the following characteristics. Parties are bound by a contractual arrangement, and the contractual arrangement gives two or more parties joint control of the arrangement. A joint arrangement is either a joint operation or a joint venture. We talk about already. Okay, once it's clear it's a joint arrangement, then it could be a joint venture. Only difference is net asset and asset liability. Okay. Joint control already we said unanimous consent through contractual agreed terms. Before assessing whether entity arrangement or not, entity first assess whether the parties or a group of parties control the arrangement. We are not using the joint control. Control the arrangement. 4 of them, 100%. Okay. Maybe the all 25, 20, 20, 25. Okay. Maybe they are 2 with the 60%, then many with small percentage. Okay. So which means the 2 with the 60% maybe controlling, provided there is a contractual arrangement. But because both have a 60%, each have 30%, none of them can control unless they have a something in between written in form of some contract or agreement. Okay. After concluding that parties or a group of parties control the joint arrangement collectively, all the 4 or 3 of them, entity shall assess whether it has a joint control of arrangement. And now we look at the joint control. For that, we will look at the contractual arrangement between A, B, C, D. Okay, that we look at. Who have the contractual arrangement, they will be having the joint control. Joint control exists only when decision about the relevant activity requires the unanimous consent of the party that collectively control the arrangement. The requirement of unanimous consent means that a party with the joint control of the arrangement can prevent any other party or group of party from making unilateral decisions. They will be part of the group which will be directing the relevant activity. Without his consent, if activity cannot be directed, then that entity, that investor has a joint control. Okay, there are things which we'll look at, three things we need to look at. One is that does the contractual arrangement give all the party control, not yet the joint control? Answer is no. So then it's outside IFRS 11. It may be something simple investment or something like that. Okay, yes. Then we look at unanimous consent, joint control. Then we look at the joint control. If answer is no, then again we are out. If answer the both is there, yes, there's a group of people who have control and there are certain people out of them who have a joint control. Then it's a joint arrangement. Once it's a joint arrangement, then it can be either joint operation or joint venture. This decision will be made on the basis of the net assets share and the assets and liability, or right in the asset, obligation the liability. That's it. Okay. First is a group of party have the control in the arrangement. Answer is yes. Out of that group, do someone have the unanimous consent agreement with that? Answer is yes. Then you move, say it's a joint arrangement. Otherwise, any one of the black boxes is missing, then it's not a joint arrangement. Okay. Then classifying the joint arrangement, right? So we look at, it depends on the right of obligation. We need to determine the type of joint arrangement by looking at the structure and form, agreed term of the contract, and fact and circumstances we look at. Okay, I'll come to these with some example. Regardless purpose, structure, and form of the arrangement, classification of joint arrangement depend upon the party right and obligation arising from the arrangement. You see that if it's a joint arrangement, then we say then it depends if it's a joint venture or joint operation. First is has to be joint arrangement. Okay. Okay. Separate vehicle or not. Joint arrangement in which asset and liability relating to the arrangement are held in a separate vehicle can either be a joint venture or joint operation. It's not necessary that there is a separate vehicle, result will be the joint venture, not necessary. Okay, and you will see that. Okay, so we have to just see, is there separate vehicle? So it could be joint venture, it could be joint. No separate vehicle, it is a joint operation. A joint arrangement that is not structured through a separate vehicle is not a joint, is a joint operation, can never be joint venture. In such cases, the contractual arrangement establishes the party right to the assets and liabilities and obligations of liabilities relating to the arrangement, and the party right to the corresponding revenue and obligation coming out of the arrangement. They also have a right to the revenue and obligation for the expenses. Okay. So we look at the legal form. We look at the contractual arrangement. Oh God, it's not working. Okay. We look at the legal form. We look at the contractual arrangement. Okay. This one legal form, contractual term, and the other facts. We look at consideration. Yes, yes, yes. No, no, no. Joint operation. So we have to look at three things: legal form and the contractual term and the other fact and circumstances. Determine whether it's a joint venture. Because I told you, if it's a separate vehicle, It could be joint venture, could be joint operation. Okay, we'll look at that. Let's look at first legal form. Legal form is not always the sole factor, but it's still very important in classifying the joint arrangement. Let's say, if we look at the joint operation, right to assets and obligation to liability. This is the first thing. Without a separate vehicle, it's a joint operation. Legal form, separate vehicle does not confer separation between the parties, which are the investor and the separate vehicle, like general partnership. So this is a joint operation. On the other side, party have a right to the net asset, first thing, as comparison. Second, there's a separate vehicle. Okay. Third is the legal form is separate. Separation from the investor and the entity itself, like corporation. So this is a joint venture, this is joint operation. Separate vehicle, separately identifiable financial structure is there, including separate legal entity or entity recognized by statute, maybe partnership act. Regardless of whether those entities have a legal personality or not. You know, corporation is a legal personality, hold the asset in its name, partnership does not hold the asset in its name, right? So that's where even separate legal entity is there, but unless there is a separation of a separate vehicle and the investor, we don't term it joint venture. Okay. Example of the legal form is A and B jointly establish a new corporation C in which each party has a 50% ownership of interest. The purpose of this arrangement is to manufacture the material required by both parties for their own individual manufacturing process. And the analysis is the incorporation enables the separation of C, which is a new entity, from the investor A Limited and B Limited. Asset and liability of C are held by the incorporated entity. And liabilities are of incorporated entity. Legal form of the separate vehicle indicates that the parties have a right to net asset. Okay, not to individual asset. If you have an investment in a corporation, you are not entitled to 2 chairs and 1 computer and 3 tables. You are not entitled to that. You are entitled to have a right over the net asset of the entity. And therefore, the new corporation is a joint venture. Okay. And now, second is the contractual term. So, as far as asset is concerned, the party will share all the interest in the asset in a specified portion, like in plant and machinery, in land, in building, right? And they will hold they are holding the asset as tenant in common and have the right to all the economic benefit generated from the assets. Okay. On the other side, joint venture, the investor do not have the interest in the asset of the arrangement. They don't have a 20% of land and 30% of building and 10% of vehicles. They have in the net asset their share. Liability. The investors share all the liability, obligation, cost, expenses in a specified portion, have the liability for claims by third party to the customers of the arrangement, because there's not a limited liability concept there. So the customer and the lender and the institution financial, they can ask for they can have a claim for their liability. Here, the investor is not liable to debt obligation of the arrangement. Party liability do not exceed their investment arrangement in limited liability case. Creditor have no recourse against any party for debt or obligation of arrangement. Fact pattern is A and B modified. Now, same arrangements. They have modified the feature of C through their contractual arrangement so that second point is the contractual arrangement. Okay, I'm talking about that. So that each has interest in the asset of the C and the liable to the liability of C. they made arrangement change. They said, let's make arrangement. Although it's a separate legal entity, we don't have a interest in the right in the net asset. We have a right in the respective asset, and we have a portion of a respective asset and proportion of respective liability. Okay, as they say. Okay. The analysis legal form of the separate indicates that the party have the right to net asset. Legal form is that. But the contractual arrangement has modification. Contractual modification to the feature C cause the arrangement to become joint operation, not joint venture. So this is a contractual modification. Terms are very important. They can override the legal form. That because this is also legally binding contract. Fact and circumstances, third thing, fact and circumstances also to be considered. There were 3 black boxes I shown you. I'm looking at the third one. Facts and circumstances might indicate a joint operation if the result in the party having the right to asset and obligation to liability, respect to liability. Example is restriction on customer, who we can sell, who we can't sell, right? Commitment to purchase all output produced by the C Limited. Expectation to fund the losses. If there will be operation losses, each will fund with their share. Right? We can see the purpose and design of that entity, why this entity is developed, for what purpose we do consider that. Commitment upon default or guarantee is not determinative of being a joint operation. Sometimes there are 2 parties. They have a commitment. If there's any one party fail to bring their share, the other party will give it that time, and then later on would recover from the other party. Okay, so this factor does not term arrangement to the joint operation. That can exist in a separate legal entity where the interest in the net asset, everything is fine. There could be one part between the party, there's a commitment and guarantee, but that doesn't affect the status of nature of the joint venture and operation. Okay. Fact pattern is on the fact and circumstances. A and B agree to purchase all the output produced by the C. Same example we're carrying out, 50-50. C cannot sell any of the output to third party unless this is approved by A and B, which is very rare. Normally, it cannot be the case. The investors say that. Price of output sold is designed to cover the expenses by C. Whatever they are getting their share in the output, at what price they are getting at the cover the expenses only. So which means operation is a break-even. This is not the normal thing. So in this case, it is the joint operation, not the joint venture. Okay. Now, an example in the real estate is A and B, real estate company, entered into a contract to acquire and operate a shopping center. A and B set up X to own the shopping center. Legal form X is such that X, not the A and B, has the right to the assets and liability of the obligation because it's a separate legal entity, a corporation. Activity include rental of retail unit, managing the car park, maintaining the center and its equipment such as lifts, and building the reputation and customer base. The parties are not liable to debt and liability of X Limited. Liability limited to unpaid capital contribution, which is normally the case in case of a company. A and B have the right to sell and pledge the interest in X. Every investor can pledge their share in the company in which they have invested to bank or to other party, can sell it to someone. A and B, maybe with the consent of other party sometime, if it's a private limited. A and B receive share of the net rental. That's what the end is. The net rental income is shared between them. What percentage, 50-50 they have. So this is the analysis is a separate legal entity. Answer is yes. Legal form, comfort separation between A and B, who are the investor, and the separate vehicle, which is X. That is the assets and liability is not X, are not of the X, not of A and B. The term A and B have a right to net asset And the fact and circumstances none indicate that A and B have a right to substantially all the economic benefit of the asset relating to the arrangement and obligation to liability. There's no such fact which is denying, which is enforcing this. There's not. So if it doesn't exist any of such thing, then it is a joint operation, a joint venture, sorry. And now oil company. A and B undertake oil and gas exploration, development, and production activity. A and B set up the separate vehicle H. One party is appointed as operator and responsible for managing the work program and the right and work program saying this well. So each well is a work program. Okay, that's not saying of the company. Okay, right and obligation of H are shared by A and B, like permit, rehabilitation, liability, royalty, taxes, and the production of H and the costs associated with the work program, each work program cost. So they have the right and obligation at a agreed proportion. Costs are covered by cash call on A and B whenever cost is incurred, new well is being explored, and they say, okay, bring 5 million each additional. Okay, that's what they're going there. And if A and B fail to satisfy its monetary obligation, other party contribute to H the amount in default, which become debt between them. This is irrelevant. This cannot affect. Okay, the other things we can say. Okay, so the other thing, separate vehicle, yes, legal form. There is a separation between investor and the entity, legal, and the terms override the legal forms, where they say A and B will have a right to the asset, production, and the cost have to obligation, the cash, cost and liability of the program. Here they have to modify the term. Fact and circumstance do not need to be considered because the legal form and term which we discuss about, they are sufficient to say that it's a joint operation, it's not a joint venture. Okay. So this is what we look at. Now we come to how to do the accounting. Remember, I said to you, there are 4 parties, A, B, C, and D. Let's say these two have a common contractual arrangement. Okay, they are not part of it. Joint control is with them, right? And now, if it's a joint operator, a joint operator recognize this is a joint operation. This is not the joint venture, because if it's a joint venture, then equity method. If it's a joint operation, then accounting is being prescribed here. A joint operator recognize in relation to interest in joint venture assets, own asset, and include the share of any asset jointly held. Liability is liability and the share in the joint liability incurred jointly. Revenue from the sale of its share of the output, like he picked up some output and sold in the market, and some output was sold jointly. Okay, jointly. So there's also share in that. The expenses, own expenses incurred for this purpose, and certain expenses incurred jointly, so share of that. So this is the way that investor will do the accounting. A joint operator account for the asset, liability, revenue, expenses relating to its investment in the joint operation according with the relevant IFRS. Maybe there's an asset which is a IS 16 one. There's an asset inventory which is IS 2. There's an asset which is the intangible IS 38. Right? That's what they say. When we take those assets and share, then they will be accounted for in accordance with the relevant IFRS. Okay. Acquisition of interest and joint venture. This simple, I want to say, okay, whenever someone acquire a share in the joint operation, then same principle of acquiring the business applies, which are given in the IFRS 3. Okay, that's one there, unless they have a conflict with the principles given in IFRS 10. Okay, otherwise acquiring. These requirements apply both to the initial acquisition and subsequent additional interest. But one thing is very important. If like we already have acquired 10%, we acquired 20% more. Remember in the other case, the previous acquired, we take it to fair value. Okay. Whenever we acquire the next chunk, the previous one we measure at fair value. Here say, in this case, it's not required because it's not a consolidation. Previously had interest will not be remeasured to fair value. That's there, okay, in that case. Okay. The party that participate in, I'm talking about party A and D, they are just participating. They are not joint. All right? D, sorry, D. B and C has a contractual arrangement. Okay. They are jointly controlling, and they say party that participates but does not have a joint control, a joint operation shall account for the interest in the arrangement in accordance with the shares. We have told you this method. I call it share basis, percentage basis, percent. They will apply the share of asset, share of liability, share of revenue. That method will be applied. Now, joint venture. In the joint venture also, there could be 4 parties. It's a separate legal entity. And B and C have the joint control. A and D are just the participator. Okay. A joint venture recognizes the interest in the joint venture as an investment and shall account for the investment using the equity method by B and C. Okay. In accordance with IAS 28, investment in associate joint venture, unless the party is exempted from applying the equity method. Already today we talked about the exemption from applying the consolidation method in IAS 28. I reminded you at that time, there was the same condition where there can be exemption from applying the equity method, otherwise equity method. A party that participates, I'm talking about A and B, a party that participates in but does not have a joint control, a joint venture account for its interest in the interest and the arrangement in accordance with the IFRS 9. In accordance with IFRS 9. Okay, financial instrument. Unless it has a significant, like D has significant influence. So of course, they will apply IAS 28 as well. Not as being a joint control holder, joint venturer, but another reason. Otherwise, A and D was required to apply IFRS 9, but D has a significant influence. In that case, they will apply the method of the equity. Look at new things are coming up. Earlier, we were IAS 28 were talking about this only, B and C, not A and B, A and D. So now we have spoke about A and D as well, right? The accounting arrangement for the joint arrangement in the entity's separate financial statement depends on the involvement of the entity in the joint arrangement and the type of the joint arrangement. If the entity is, we're talking about the separate account now, separate account, separate. If the entity is the joint operator or joint venturer, I mean, not A and D, we're talking about B and C. B and C, which have a unanimous arrangement in cash, shall account for the interest in the joint operation in accordance with the basis of the shares we already talked about. And joint venture in accordance with the paragraph 10 of IAS 20, separate financial statement. Cost or IFRS method, 9 method, okay? So this is about the separate account, and for B and C, which are the joint operator, have a joint control. which are the joint venture, have the joint control. If the entity is a party that participates, I mean, I'm talking about A and D, that participates but does not have a joint control, a joint arrangement shall be accounted for its interest in the following way. Joint operation, if there's a joint operation, then they will go to basis of share percentage, already talked about, each individual asset, each individual liability. But if it's a joint venture, then they will apply IFRS 9. We're talking about A and T. In my language, called the Shamle Baja. They are Shamle Baja, right? They are not the showrunner. Okay, so they will apply IFRS 9 unless the entity has significant influence over the joint venture, in which case they can apply the paragraph 10, which is a cost equity method, or IFRS 10. Three methods of them they're available to them. Okay. Okay, mutual transaction can also take place, like we discussed as in case of a joint venture and associate can take place. If it's a loss, every party have to recognize their share of loss. From the transaction, if there's a loss, it indicates the impairment. So they have to recognize the loss, even the assets and things are still in their possession. Even it's not a realized loss. Okay, they have to. But in case of a profit, they have to defer their share of recognizing their share of gain, because they cannot have a gain from themselves. Okay, until that asset is sold to the third party, they have to wait till that. Okay, that we also discussed under the IS 28. Disclosure is also reminding you there's no disclosure specified in IFRS 10. All disclosures are going to be covered in IFRS 12. And this was also applicable from January 1st, 2023, accounting beginning on or after that. Okay, so this is your IFRS 11. Okay. We are left with the question. Any question? Any question? We left with the 13 minutes and sufficient to go through the next 7-8 slides. Okay, provided we have any question related to that. I try to give you the distinction, joint operation, joint venture. Once it's operation, they could be party which are joint operator, which could be party which are just participator. If it's a joint venture, they are party which have the joint control and they are the other party than the joint venturer. How the accounting of those and will be also done. That we covered there. Any question? Should I move forward? Anyone should answer. Otherwise, I'm scared. I thought 59 people are there, but all have left the computer
No, I
system
think we are
on.
good. I think we are good. We can proceed, Cool, sir. Thank you.
Okay. Thank you. Okay. Now disclosure. It's a very. I told you, neither IFRS 10, not 11, not IS 28 has any disclosure requirement. They all has been brought to IFRS 12. Why? The answer is why. The financial crisis in 2007 highlighted one thing. That was, my pen ink is getting dried, so I will let me dip it. Okay. Okay. So highlighted the lack of transparency about the risk which a reporting entity was exposed to due to their involvement with the structured entity, okay, including those they have sponsored. There was a lack of transparency. So what they did is then they found also there's an overlap of many disclosures, right? In IS 27, IS 28. At that time, IS 27 was dealing with the consolidation as well. And IS 28 and IS 31, which was used to deal with the joint venture. Okay. So as we concluded, there should be a combined disclosure. It will be easier for people to understand if it's a combined disclosure in one place. Okay. So they brought all the disclosure at one place. And the one thing is very important. They say foreign have interest in the subsidy, joint arrangement, associate. We already looked at. And in unconsolidated structure entity, we never thought about what does it mean. Unstructured, unconsolidated structured entity. Okay. I will look at that with a little example. Okay. So they have set out the overall objective of the disclosure. They say the disclosure should be such which should enable the user to evaluate the nature of its interest in other entities and risk associated with interest in other associates. I'm separating it. Nature of its interest in other entity, risk associated with this interest in other entity. The effect of such interest on the financial position, financial performance, and cash flow of the investor. Okay. They have overriding requirement there. They say where the disclosure required by IFRS 12, which we are going to look at on coming slides. Okay. Together with the disclosure required by other IFRS, do not meet the above objective, and entity is required to give more and more and more disclosure till that objective is met. Okay. Now, I've required to give a disclosure for the interest in case of subsidy, joint arrangement, which could be joint operation, joint venture could be, associate, and unconsolidated structured entity. What are these? We'll look at that. IF12 does not apply to certain employee benefit. Leave it this, which it doesn't apply when it's come to you. You look at that because I just don't want to waste time on that. Okay. Right. Now, each kind of investment, what disclosure should be there? The objective of value to require the disclosure of the information that enable the user of financial statement. Oh, I already covered that. I gone back. Okay. Yeah. Oh, interest in other entity. Okay. There could be different kind of interest: contractual, non-contractual, involvement that exposes an entity to variability of return from the performance of entity. Interest in other entity can be evidenced by but not limited to holding equity and debt instruments, such as well as other form of involvement, such as providing funding, liquidity support, credit enhancement, guarantee. These are all kind of involvement are there. Not only the investing in that company only. It includes the means by which entity has a control, a joint control of, or significant influence over the other entity. Okay. The various way of having the control, joint control, significant influence over the other entity. Like in case of an entity, significant influence shows you a list of 4 or 5 items. If like interchange of technical information, transfer of the personnel, being participating in the board, like that. Okay. Entity does not necessarily have interest in other entities solely because of the typical customer supplier relationship. Although customer supplier also have interest in other, but that is excluded from our discussion. That's the normal one. That's not to be looked at. But the first paragraph one, investment in the instrument, providing the funding, liquidity support, credit enhancement, guarantee type, they are involvement which exposed to the other party to the risk variability of return. Okay, what is a structured entity? Okay, whether it's consolidated or not, that's a separate thing. Okay, what is a structured entity? Entity that has been designed so that the voting or similar rights are not the dominant factor in deciding who controls the entity, such as when any voting right relate to the administrative class only and the relevant activities are directed by means of contractual arrangement. Let me give you an example. Let's say there is a pharmaceutical or research going on, okay? And BG has given 95% funding. Bill Gates has given 95% investment. And two scientists has given 5% investment. Okay. But scientists said under a contractual arrangement, give us the voting power of 90% voting power. So no one should stop us from our work, because the technical work, we don't want to listen your bullshit, BG. Okay. So voting right should be 90%. And you appoint a person who would have a 10% voting right. Okay. Okay. This is the structured entity. Now you give me the answer. Who has the control? Any
Scientist?
wise person can answer. Who has the control?
Scientist? Two scientists?
BG, variability of return. They are also giving them the remuneration of 5 million each in a year and 5% return. Okay, which is very nominal. If research goes successful, the negative or positive variation of return is for this guy, not for the scientist. Agreed? That is the administrative power given to them. Okay. The return variability and size is with the BG. Okay, so this is structured entity. Now, the scientists will not consolidate it. BG will consolidate it because has the control. This is example of structured entity where the people who are actually running the show they're running under the contractual arrangement. Okay, under the contractual arrangement. Okay. Otherwise, they don't have. Even voting right is under the contractual. They just know 90% depend on that. Okay. The other is you can just listen with 10%. Whether you apply that, whether you listen to that discussion or not is up to the scientist. Okay. Now, structured entity can be two types. One is unconsolidated. Okay. From scientist point of view, there's a structured entity. They have involvement there, they have investment there, but that's an unconsolidated structured entity. For PG, it is a structured entity, but consolidated structured entity because control is lying with the PG and has to consolidate as per IF 10. Okay. Now, so we need to disclose the broad objective category and nature of this disclosure. Just next few minutes look at the disclosure. We have to disclose the significant judgment and assumption which have been applied. Where it can be applied? Here. Whether there's a control or not, whether it's a joint control of arrangement, whether significant influence exists or not, a lot of judgment and assumption are there. The type of joint arrangement is a joint operation or joint venture. We have to look at many things. We have to make a lot of judgment here. So you need to disclose the significant judgment and assumption which help you, which made you to reach some conclusion. That disclosure is required. Okay. In consolidated financial statement, you enable the user of consolidated financial statement if the subsidy, interest and subsidy, the composition of group, the understand the non-controlling interest, right? And the having in the group activity and cash flow, and significant restriction, if any, on the ability of access and use of the asset and settlement. Like maybe there's a subsidy of UK company in Pakistan, but there's significant restriction of transfer of fund in these days. They need to be disclosed. Evaluate the nature and changes in the risk associated with the interest in the consolidated structured entities. This is the word structured, consolidated structured entity. Okay. Structured entity I just defined, GB and the scientist. Okay. But I said GB will consolidate. So it's they're telling the GB to evaluate the nature and change in the risk associated with the interest in consolidated structure entity. Evaluate the consequence of change in the ownership, like you from 80% to go into 60% or 40%, right? So this is has to be disclosed. Are you going up from 40% to 70% for that? And it's we are talking about the reduction actually, without losing the control, by losing the control. Okay. By losing the control, there could be reduction, de-recognition, asset liability, and the recognition of remaining interest which you are retaining at fair value, booking the gain and loss. In the first case, not booking the gain and loss. The difference go to the statement changes equity, how much, that's disclosure. Okay. So interest in the other case, like the entry discloses information that enables the user of financial statement to evaluate nature, extent, and financial effect of the interest in the joint arrangement and the associate. This is for joint investment in joint venture and joint associate talking about, including the nature and effect of the contractual relationship. You know, there's a contractual relationship, and so they are saying maybe there's a contractual relationship between the B and C. Maybe other than this investment, also they have some other like maybe some contractual arrangement with the A and D as well, which doesn't give them the joint control, but still there's a contractual arrangement, if any. So you can have to talk about that. Basically, it's not A and D. Like these one, they may be for this investment, they have a contractual arrangement, maybe some other contractual arrangement also there between them. That should be disclosed. Okay. The nature of and the change in the risk associated with the interest in the joint venture and associate. Okay. The first is the size of interest, and the other is the risk level, change in the risk as well. This is the second one. And the interest in unconsolidated structure entity. Okay. So now I'm talking about the scientist. Okay. Entity shall disclose the information that enables the user of financial statement to understand the nature, extent of the interest, as we discussed earlier, where in unconsolidated structure entity. Earlier we said in joint venture, in joint associate, now in unstructured entity. Evaluate the nature and change in the risk level. We already talked about, but in the previous way we talked about relating to associate and joint venture. Here we are talking about unconsolidated structure entity. Here I'm saying IFRS 10 deal with the structure entity which are consolidated from GB point of view. Okay, IFRS deal with the situation where the structure entity is not consolidated. So that disclosure about the non-structure. Otherwise, IFRS 10 deal with that, and all the consolidation process will be as per IFRS 10. Okay, just take us through. So this is the applicability of IFRS 12. Okay. Any question? 5 minutes up. Okay. I'm not worried about myself that much as I'm worried about you people, because you have a commitment to the families and others, and we here are free citizens. Okay. Any question? I will share these slides, and then these can be provided to you people by the MC of Canada chapter, but that would be sent as soon as possible. Maybe tomorrow morning I will share.
Assalamu alaikum. Maqbool sahab, can you hear me?
Yes, I can.
I put a question in the chat, if you can just take a look at that. Jazakallah khair for your presentation.
Okay, this is the. This is when we consolidate? This is the question?
I think the last question is regarding setting up a special purpose entity. Saad Malik
Setting
has
up?
Yeah,
Setting up?
Saad Malik has asked that if we imagine a special purpose entity set up as non-profit for arm's length transaction in order for lenders to invest and borrowers to obtain halal financing, could we see a case where this would not be required to be consolidated by any of the lending entity? This is a question you can see on the chat window, second last message, Maqbool sir.
Said I cannot see the question on chat window.
What are the criteria to assess the presentation of share of a profit or loss in this joint venture in statement of profit on either part of operating? Actually, this was already discussed.
Would you prefer, would it be easier if I just read out the question again?
Look at that. Actually, what I understood, on the basis of that, I'm going to reply. So, okay, I would say make another attempt to make me understand the question, please.
Sure. Okay. Let me try and
Okay,
articulate.
yeah, borrow to obtain halal financing. Can you see a case whereby this would not be required to be consolidated by any of the commercial lending entity? No. It's a control. It's a control, right? Basic is a control. If the lending institution has set up a special purpose vehicle, and that special purpose vehicle is doing some activity, and then it's controlled by the investor, the lending institution. The point is the control. Who is the controlling? Okay, the nature of business, the difference in that is disregarded. Basically, the control, not even the legal form of the entity, not even the legal form of the entity.
So I
Okay.
guess, yes, thank you. I guess what I was envisioning was, supposing we set it up as a non-profit, so we don't have control, we don't get any variable returns, we don't have that ability to control the level of activity. There is a transactional relationship for lenders who wish to invest in this, and it's not set up as our own entity, it's set up as a pool whereby various lenders can participate in this. So just try to wonder if that's and if you haven't seen something like that, then that's fair enough.
You are only saying it's not a profit entity. There's not a variation of the return there. So we are talking about the business combination here. If that doesn't come up as a business, then will be out of that, because the whole idea of this IFRS 10, 11, 12 we're talking about is particularly 10, even the I talk about the joint operation as well, even the joint venture as well. This has to be first the business, okay? But they're not acquiring, right? They are setting up. So I feel it's not the 3 points are there. You have to look at the 3 points, okay? So if the only 100% one is owning that, and basically question arises when there are 2, 3 parties are there, we have to decide who controls it. Then we look the variability of the return. Then we look at the ability to direct. Then we look at the power to affect that return, right? Whether negative or positive. It's not only profit, even the losses, okay? We look at that and decide out of those 3, which one controls actually. Here, if they're setting up a special purpose vehicle, which is totally controlled by them, okay, totally, there's no question of rise no confusion arise. Who is controlling that? Okay, in that case, probably those 3 factors does not come that way. That's my personal view on that.
Yeah, just to add on that, Maqbool Saab. So in not-for-profit organization, if like normally what happens in Canada is like not-for-profit is owned by the board of directors. So what Maqbool Saab is just said that if you are not combining it, if it's not a business combination, if there is no acquisition, if you are just setting it up, then probably you would have to look at the board of directors, who are the members, who are the directors who controls the entity, and also the fact that from those board of directors, is there any board of directors which are coming from the investors or the lenders? So if there are no if there are no directors from that lending company or the investing company, and the board is separate, then the board is responsible for making decisions where to get the lending from, where to put the lending to, where to invest. So the board would be independent, and in that case, I don't think there is no acquisition, there is no business combination, so there would not be any problem.
Yeah, and maybe if a bank is just a lending institution, just putting 1 or 2% of their in the board, and the rest are the outside philanthropists and all other welfare organizations that are being represented and activists and others, then the control is maybe significant influence is there. Then could be the equity method, right? In that case. So, but
Right.
in the other case, if they have set up something and given it independence to it, none of them is controlling, none of them is. So then it's not a matter of consolidation at all.
Jazakallah khair. That's extremely valuable advice. Thank you.
Yeah, thank you. Thank you very much.
I think, Maqbool Saab, we don't see any other questions on the chat. If anyone wants to ask the question, this is your last chance. We'll just wait for a couple of seconds now because we are already over by 12 minutes. And we'll wait if you have any question in the meantime. I just want to thank everyone who took out time on a Saturday morning, and also special thanks to Maqbool Saab for taking out like 2.5 hours and to guide us, teach us on these important IFRS.
My pleasure. Thank you very much for having me here. And I had the opportunity of sharing my knowledge, and it was two-way learning, and I'm really delighted. Thank you very much.